We're seeing something in the housing market that no generation before us has ever seen. A 50-year mortgage, half a century of debt, suddenly marketed as the new path to affordability. And that's not the only red flag. Homes are sitting longer on the market. Inventory is rising faster than anyone expected. Builders are offering incentives they never had to offer before. Something is shifting, and it's shifting fast. But here's the part no one can ignore. Fannie Mae is now moving to approve mortgages without a credit score. No score, no history, no guardrails. When a system starts stretching loans to 50 years and lowering credit standards at the exact same time. This isn't innovation, it's a signal. A signal that the real problem isn't affordability. It's the system itself. A system that is quietly rewriting the meaning of homeownership in America. Tonight, we uncover why all of this is happening now, and who actually benefits when Americans are asked to carry debt that outlives their working lives. The paradox, a new solution that has never existed before. For nearly a century, one thing in American housing never changed. The mortgage stopped at 30 years, not 40, not 45, 30. Even through the Great Depression, the stagflation of the 1970s, the subprime crisis of 2008, and the pandemic inflation shock, America never crossed the 30-year line. Until now. For the first time in the history of U.S. housing policy, a 50-year mortgage is being studied, promoted, and quietly prepared as a new standard solution for the next generation. It's unprecedented, it's radical, and if introduced, it will fundamentally transform what it means to own a home in the United States. But before we can understand why the housing industry is willing to rewrite its own rules, we need to understand how the current rules were created in the first place. Because the 30-year mortgage, the one everyone thinks is normal, didn't evolve naturally. It wasn't born from market forces. It wasn't the result of consumer choice. It was engineered in a moment of national crisis by institutions facing collapse to save a system on the verge of total failure. And the pattern we're seeing now looks eerily similar. The origin of the modern American mortgage. To see the danger in a 50-year mortgage, we must go back to the era when the 30-year mortgage was created, not because the system wanted to help people, but because it needed to save itself. Before the 1930s, mortgages in America were harsh and unforgiving. Terms lasted only 3 to 10 years. Payments were interest only. And at the end, homeowners faced a massive balloon payment, the entire principal due at once. It was a brutal system that demanded perfection from borrowers and offered no safety net when life went sideways. Then the Great Depression arrived, and the entire structure collapsed overnight. Banks ran out of money, millions of families defaulted, homes were seized in waves, the housing market froze, the financial system buckled. By 1933, nearly half of all mortgages in America were in default. The government had no choice but to intervene. The new architecture of housing. In 1934, the FHA was created. In 1938, Fannie Mae was born. Their mission wasn't philosophical, it was survival. Stabilize banks, restart lending, prevent mass homelessness, spread risk through government guarantees, create a mortgage Americans could realistically complete. And so, the 30-year, fully amortized mortgage was engineered. Not because it was ideal, not because it was fair, but because it was the safest design for a system trying not to collapse. For nearly a century, that design held. Through recessions, wars, booms, and bubbles, the 30-year mortgage remained the backbone of the middle class. And now suddenly that backbone is being stretched to 50 years. So why now? Why this change? Why this moment? Because the housing market is experiencing pressures not seen in decades. Prices are at historic highs, supply is at historic lows. Wages lag far behind, interest rates are elevated, younger generations are locked out. Institutional investors are flooding the market, and political pressure is rising. The system is strained, and when systems strain, they don't shrink, they stretch. They stretch debt. They stretch terms. They stretch the definition of affordable until it becomes unrecognizable. Just like they're doing now. The 50-year mortgage isn't a solution. It's a warning sign. And now that we've uncovered the origin of the system, the next question is the one that matters most. Who benefits from a mortgage that lasts half a century? And why are they pushing it now? To understand why a 50-year mortgage is suddenly being discussed for the first time in American history, we need to step back and look at the housing market not as a collection of individual buyers, but as a system. Because systems behave predictably. They repeat patterns. They respond to stress the same way, decade after decade. And the pattern we are seeing right now, stretching debt farther than ever before, isn't new. It's the classic response of a system that can't solve affordability, and instead tries to outgrow it. The pattern always begins with the same problem. When homes become too expensive for the average family, the system faces a dilemma: lower prices, which hurts banks, builders, investors, and asset values, or change the rules, which protects the system, not the buyer. And history shows us every time the system chooses the second option. Let's take a closer look. Before the 30-year mortgage, the system was breaking. Before 1934, short-term mortgages with balloon payments were the standard. Why? Because banks wanted security, they wanted quick repayment, they wanted minimal risk. But when the Great Depression hit, that model collapsed. Millions defaulted, homes flooded the market, banks drowned in foreclosures, the housing economy froze solid. The system didn't adapt to protect families, it adapted to prevent total financial collapse. So the government engineered a new tool, the 30-year, fully amortized mortgage. Longer terms, lower monthly payments, a national bailout disguised as a consumer-friendly innovation. This wasn't generosity, it was survival. And the important part is this: they stretched the timeline of debt to keep the system alive. The same pattern appeared again in the 1970s. In the 1970s, inflation exploded. Mortgage rates jumped to 12%, then 15%, then above 18%. People couldn't afford homes. The system faced the same dilemma: drop prices or change the rules. So what happened? They created adjustable rate mortgages, ARMs, a financial invention that temporarily made monthly payments look cheaper, while hiding the long-term risk. Again, when affordability collapsed, they didn't touch prices, they stretched and twisted the structure of debt. Then came the 2000s, and the pattern got dangerous. Home prices skyrocketed between 2000 and 2007. Wages didn't. Buyers were priced out. So what did lenders do? They didn't lower prices. They didn't slow down the bubble. They didn't protect buyers. They invented subprime loans, negative amortization loans, no income, no job, no assets, ninja loans, teaser rate ARMs, interest-only loans. Every new product had the same purpose: make an unaffordable home appear affordable through creative debt. The system stretched again, further than ever, until it snapped in 2008. Today, the same pressure, the same system, a new weapon fast forward to 2025. Mortgage rates are double what they were in 2020. Home prices have surged nearly 45% in 4 years. Inventory is tight, wages lag far behind. Institutional investors are buying entire neighborhoods. Younger generations are locked out of the market completely. The system is under the same pressure as 1933, the same pressure as 1978, the same pressure as 2006. And whenever the system faces that pressure, it follows the same script: don't reduce prices, modify the debt. But there's a problem this time. They've already used most of the old tools. ARMs have been done, interest-only loans have been done, subprime lending has been done, loose credit standards have been done, mortgage forbearance has been done, so now they need something they have never used before. Something unprecedented, something big enough to stretch affordability artificially, without touching home prices. And that something is the 50-year mortgage. Why a 50-year mortgage is a sign of systemic desperation. A financial system introduces ultra-long mortgages only when it has run out of other ways to keep prices high. Japan did it when their bubble collapsed in the 1980s. Banks didn't lower prices, they extended loans. Then 50-year mortgages became 70-year, then 100-year, then multi-generational. It wasn't innovation. It was panic disguised as policy. And the same pattern is forming in the US now. Prices too high, wages too low, inventory too tight, buyers locked out, political pressure rising, economic stress building. So, the system does what it always does when cornered. It stretches debt far beyond what a human life can comfortably sustain. A 50-year mortgage doesn't appear in a healthy market. It appears when the system cannot allow prices to fall. And once you recognize the pattern, it's impossible to unsee. The question that opens the next part: if the 50-year mortgage is not designed for buyers, then who is it really designed to protect? Who gains from a society where people never finish paying for their homes? And why does this shift arrive right as the market begins showing signs of slowing, right as inventory climbs, right as builders start offering incentives, and right as Fannie Mae removes credit score barriers? The answer reveals the true power structure behind American housing. Whenever a new financial idea appears in America, especially one as unprecedented as a 50-year mortgage, it asks never enough to ask what it is. You must ask, who benefits? Because in financial history, no major policy shift has ever been designed for the average person first. It is always designed to solve a deeper problem somewhere else in the system. And a 50-year mortgage, introduced at the exact moment the market is cracking, is a clue. A breadcrumb pointing to the real winners in this story. The first winner: real estate agents and brokers. The math is simple. Higher home prices, higher commissions. A 50-year mortgage makes expensive homes look cheaper by lowering monthly payments. When more people qualify, competition returns. Competition pushes prices up. Higher prices push commissions up. Agents don't need homes to become affordable. They need homes to sell. And nothing sells better than a loan that stretches just far enough to feel possible. The second winner: home builders. Builders don't profit from affordability. They profit from demand. And a 50-year mortgage instantly widens the pool of qualified buyers, especially younger people who are pushed out of the market right now. More qualified buyers, more contracts, more developments, more units sold. But here's the hidden cost. When builders know people can afford longer mortgages, they raise prices to absorb the extra headroom. It happened in the 1970s with adjustable rates. It happened in the 2000s with subprime loans. And it will happen again with a 50-year mortgage, because builders don't lower prices when loans get cheaper. They raise them. The third winner: banks. Banks see a 50-year mortgage differently from consumers. Consumers see the monthly payment. Banks see 600 months of interest. That's what a 50-year mortgage is: a predictable, long-duration income stream that lasts through recessions, political cycles, and even generational turnover. The longer the term, the more interest earned. The more interest earned, the more valuable the mortgage-backed securities become. A 50-year mortgage isn't just a home loan, it's a bond, one that spits out cash for half a lifetime. And for banks, that's not just profit, it's stability. The fourth winner: institutional investors. This is the group that benefits the most, and the group almost no one talks about. Over the last decade, massive financial firms have been quietly buying entire neighborhoods: BlackRock, Invitation Homes, American Homes. 4. Rent, Tricon, residential global pension and sovereign wealth funds. Why? Because single-family homes offer reliable rent, inflation protection, long-term appreciation, low volatility, government-favored tax treatment. Now add a 50-year mortgage into the mix. It doesn't hurt them. It helps them. Here's why. When long-term loans stretch affordability artificially, home prices rise. When home prices rise, regular buyers get pushed out. When buyers get pushed out, they rent. And who owns the rental stock? Not individuals. Institutions. A 50-year mortgage enhances the greatest transfer of housing ownership in modern American history, from families to Wall Street. This isn't theory, it's already happening. In some cities, 1 in 5 homes is purchased by institutional investors. In others, it's 1 in 3. A 50-year mortgage accelerates this shift. The fifth winner: the system itself. When you step back, the biggest winner isn't a single industry. It's the structure holding everything together. A structure that needs High home prices, steady mortgage payments, stable mortgage-backed securities, and a population tied to long-term debt. Because debt is the backbone of the American financial system. Not equity, not ownership, debt. A 50-year mortgage doesn't strengthen families. It strengthens the system that depends on families making payments forever. It turns homes, the most emotional asset, into 50-year financial products. And it turns people, the most human part of the economy, into permanent payers. So who loses? Only one group, the ordinary American buyer. The person who believes the lower monthly payment is a gift. The family who thinks they're buying stability. The couple trying to start a life, the single parent trying to break out of renting. The young generation already drowning in student debt. They aren't being offered a path to ownership. They're being offered a financial illusion, a home that feels affordable today, in exchange for a lifetime of payments tomorrow. And the most dangerous part, most people will accept it, not because they're careless, but because the psychological trap is precisely engineered. Humans don't think in decades. We think in monthly payments. The system knows this. The banks know this. The builders know this. The investors know this. Only the buyers don't. And this brings us to the next truth if the winners are clear. And the losers are the very people the policy claims to help. Then the question becomes unavoidable. What does this shift say about the future of home ownership in America? And what kind of society emerges when people never finish paying for the place they live? The answer begins in the next part, where the consequences shift from the financial to the deeply personal. Up to this point, everything has sounded like a macro problem. A debate about markets, policy, interest rates, incentives, and institutions. But the true impact of a 50-year mortgage isn't measured in charts or economic models. It's measured in time, in lives, in the quiet decades between the first payment and the last. Because when a mortgage stretches to 50 years, the consequences don't happen in the economy. They happen inside a household, inside a marriage, inside a family. Inside the hopes of an entire generation that believes they're buying stability when they're really buying permanence. Permanence of debt. The split path. Two buyers, same house, completely different futures. Imagine two buyers purchasing the same $500,000 home on the same street, just with different loan terms. Buyer A chooses a 30-year mortgage. Buyer B chooses a 50-year mortgage. On day one, they look identical. Same home, same keys, same excitement, same belief in the dream. But over the next decades, their lives quietly drift apart, not because of decisions, but because of structure. Buyer A, the traditional timeline. Buyer A pays off the home around age 55-60. That single milestone reshapes everything. The mortgage disappears. Cash flow opens up. Retirement becomes possible. Risk-taking becomes safer. Investments can compound. Emergencies don't destroy savings. Work becomes a choice, not a necessity. Even psychologically, something profound happens. A paid-off home gives a person confidence. The feeling that no matter what happens in the economy, their foundation is secure. For nearly a century, this milestone defined the American middle class. It was the line between surviving and stabilizing. Buyer B, the 50-year timeline. Buyer B, meanwhile, is still paying at age 55, still paying at 60, still paying at 70, still paying in many cases at 75 or even 80. And this changes everything. Retirement becomes fragile, savings remain thin. Investments are delayed, emergencies become disasters, mobility disappears. Every decision revolves around the monthly payment. A 50-year mortgage isn't simply a long loan, it's a life commitment. It locks a person into their job. It locks them into their city. It locks them into a financial routine that leaves almost no room for error. And the psychological cost is even heavier. You don't feel like you own your home. You feel like your home owns you. The Great American Retirement Collision. America is already facing a retirement crisis. 45% of Americans have $0 saved. The average 55-year-old has less than $100,000. Healthcare costs are rising. Social security is strained. Now add a mortgage payment into that equation. For previous generations, the key to surviving retirement was simple. At least the house is paid off. Without that safety net, everything changes. An elderly couple entering retirement with a $2,500 monthly mortgage payment isn't retiring. They're extending their working life until their body fails, or their finances do. A 50-year mortgage doesn't just change your payments. It changes how and when you can stop working. It ties your future to your past. It locks your labor to your shelter. It erases the financial breathing room that older Americans once relied on. The lost equity generation. Equity is the quiet wealth of the middle class. It funds retirement, protects families, absorbs shocks, transfers wealth to children. A 30-year mortgage builds equity steadily. A 50-year mortgage barely builds equity at all for decades. By year 30, the 30-year mortgage is paid off. The 50-year borrower still owes most of the balance, often more than $380,000. One is building stability, the other is building dependence. One becomes an owner, the other becomes a lifetime payer. This is how the wealth gap widens, not through income inequality, but through asset timeline inequality. Two families with the same income can live in two different financial universes depending on whether their mortgage ends or doesn't. The psychological burden. A future you never reach. One of the most overlooked consequences of a 50-year mortgage is psychological. A mortgage that ends at 60 gives people a finish line. A 50-year mortgage removes it. Living without a finish line changes people. They take fewer risks. They switch jobs less. They relocate less. They delay marriage. They delay children. They live with a constant quiet stress. They feel like they're behind, even when they're doing everything right. And over 50 years, this stress compounds faster than interest. Because debt isn't just a financial number. It's time, it's energy, it's mental bandwidth. It's the feeling of carrying something heavy every day, even when the world thinks you're successful. The final question that opens the next chapter. If a 50-year mortgage reshapes a person's life this profoundly, then what does it do to an entire nation? What happens when millions of people enter old age with debt, when equity disappears from the middle class, when ownership becomes delayed so far that it barely exists? The answer lifts this story from the personal to the structural, from the household to the country. And that's where we go next. When millions of individual lives begin drifting in the same direction, working longer, saving less, building equity slower, retiring later, the consequences are no longer personal. They become national. A 50-year mortgage doesn't just stretch the finances of a single household. It stretches the entire social fabric of a country. Because when the foundation of ownership changes, the character of a nation changes with it. And today, America stands on the edge of one of the most profound shifts in its modern history. The shift begins silently. A country where fewer people own anything outright. For nearly a century, the middle class was built on one assumption. You work hard, you pay off your home. Your home becomes your anchor. It was the stabilizing force in American life. The difference between financial chaos and security, between vulnerability and dignity. But if mortgages stretch to 50 years, that anchor disappears. Suddenly, fewer retirees own homes outright, fewer families accumulate generational wealth, fewer households can leverage equity, fewer Americans experience financial stability, fewer young adults inherit assets. This is how societies drift away from the middle-class model and towards something far more fragile. Because a nation where millions retire with mortgages isn't just stressed, it's structurally unstable. The retirement system collides with reality. Retirement in America is already under pressure, Social Security is strained, healthcare costs are rising, pensions are shrinking, lifespans are increasing, market volatility is growing. Now, imagine layering a 50-year mortgage on top of that. Millions will enter retirement with mortgage payments, property taxes, insurance, maintenance costs, rising utility bills, no equity cushion. This combination is unprecedented in American history. For decades, economists warned about the retirement crisis. A 50-year mortgage doesn't just worsen it, it weaponizes it. Because nothing exposes the weakness of a retirement system faster than a generation that cannot afford to stop working. This isn't speculation. It's math. cold, ruthless math. The shrinking middle class and the return of a renting society. The United States was built on ownership. In fact, it is the only major country in modern history where home ownership defined identity, success, and security for such a large portion of the population. But when ownership is delayed by 20 additional years, ownership becomes the exception, not the norm. Here's what happens next, historically and economically. 1. The middle class begins shrinking, not because incomes fall, but because wealth stops accumulating. 2. The working class grows, because people devoting 50% of their income to housing can never break out of survival mode. 3. A permanent renter class emerges, even among people who technically have a mortgage. 4. Wealth concentrates at the top because the affluent avoid long-term debt and buy properties in cash or with shorter terms. 5. Social mobility collapses because you can't climb financial ladders while carrying a 50-year obligation on your back. This is the same pattern seen in Rome before its economic decline, Japan during the lost decades, Britain during its slow post-war unraveling, Spain during its empire's inflation spiral. Different countries, different eras, same pattern. When ownership becomes delayed, society becomes divided. Institutional landlords grow stronger, and why that should scare you. One of the most alarming transformations in the US housing market is also one of the quietest. Institutional investors are becoming America's new landlords. And a 50-year mortgage accelerates this shift dramatically. Here's why. When prices rise, individuals lose. When prices rise, institutions win. When people can't afford to buy, they rent. When people rent, institutions profit. When institutions profit, they buy more homes. It becomes a cycle, self-feeding, self-expanding, where ownership drains from the hands of families and flows into balance sheets of corporations. This is not a conspiracy, it's happening in real time. In some cities, 1 out of every 3 home purchases is made by an institutional landlord. The 50-year mortgage gives them an even bigger advantage, because the longer the debt term, the easier it is for institutions to outbid families, because institutions don't borrow like individuals. They borrow in bulk, at lower rates, with better terms, and with no fear of long timelines. This is how a nation shifts from home ownership, rentership, corporate ownership. And once that transformation begins, it rarely reverses. What happens to a nation when people never arrive? In America, owning a home wasn't just a financial goal. It was a psychological one. It represented stability, adulthood, safety, pride, legacy, roots. But if mortgages stretch into old age, arrival, the moment when life feels anchored and secure, gets pushed further and further into the future. Some people never arrive at all, and that has consequences far beyond the balance sheet. Families delay children, communities become transient, trust in institutions erodes, national optimism declines, social tension rises, economic anxiety becomes chronic. Because a society where people never feel settled is a society permanently on edge. The question that opens the next chapter. If a 50-year mortgage can reshape a nation this deeply, then what is the ultimate impact? What happens when millions reach age 70 with debt? What happens when the middle class loses the asset that made it possible? What happens when ownership collapses and the economic engine that built America begins to stall? The final chapter answers that by exposing the full pattern, the final consequences, and the awakening that this generation must confront. Every major shift in American finance has a moment, a single, seemingly small decision, that reveals the truth of the entire system. In the 1980s, it was the adjustable rate mortgage. In the 2000s, it was the subprime loan. And today, it is the 50-year mortgage. Because a mortgage that lasts longer than a person's working life isn't just a new policy, it's a new identity. It transforms the American dream from something you eventually own into something you permanently owe. And the deeper you look, the clearer the truth becomes. A 50-year mortgage isn't designed to help you buy a home. It's designed to keep you paying for one. The silent cost. How permanent debt controls people. Most people think about debt financially, but debt's greatest power isn't financial, it's psychological. Long-term debt reshapes how people behave. It limits risk-taking, it discourages career changes, it makes relocation nearly impossible. It keeps people tied to jobs they no longer love. It forces families to prioritize survival over ambition. It narrows life choices down to one question: can I afford the payment? This isn't accidental, it's structural. Because a person with a 50-year mortgage is not free. They're stable enough to keep working, but not stable enough to stop. That is the perfect consumer for a modern financial system. Productive, predictable, permanent. The wealth gap widens, not from income, but from timeline. Here's a truth almost no economist says out loud. Two families earning the same income will live completely different lives. If one finishes their mortgage at 55 and the other finishes at 80, same salaries, same jobs, same taxes, same economy. But one builds equity for decades, while the other spends decades treading water. That's how wealth inequality grows. Not from generations earning less, but from generations owning later. A 30-year mortgage creates a wealth arc, a 50-year mortgage flattens it, and the people who lose aren't careless. They're simply trapped in the structure. The psychology of never arriving. For nearly a century, homeownership gave Americans a sense of arrival, the moment life felt anchored, stable, and safe. A paid-off home symbolized dignity, completion, security, a legacy, a future. But a 50-year mortgage doesn't allow arrival. It delays it. It stretches it. It eventually erases it. When people never arrive, something changes inside them. Optimism fades, stress becomes chronic, mobility disappears, confidence erodes, communities weaken. Because deep down, humans need a finish line. Without it, life becomes a loop, a routine of paying, working, paying, until age 75 or 80. This is not home ownership. It's financial treadmill syndrome. The society that emerges from lifetime debt. If a 50-year mortgage becomes the norm, if millions begin carrying debt deep into old age, the transformation is unavoidable. A new society emerges. 1. A society where ownership collapses. Because stretching debt does not increase access, it only increases prices. 2. A society where wealth centralizes, because only institutions benefit from higher prices. 3. A society where the middle class dissolves. Not through catastrophe, but through slow erosion. 4. A society where retirement weakens. Because without paid-off homes, retirement becomes a math problem with no solution. 5. A society where freedom shrinks. Because you cannot be free if you cannot stop paying. This isn't theory, it's history. It happened in Rome, before the collapse of its currency. Britain, before the end of its reserve empire Japan. Before its lost decades Spain. Before its imperial decline. In every case, the same pattern repeats. When a population loses ownership, it loses autonomy. When it loses autonomy, it loses stability. When it loses stability, the system eventually breaks. The entire cycle in one sentence. Everything you've seen in this story, the history, the incentives, the winners, the losers, the consequences, collapses into a single truth. A 50-year mortgage does not make homes more affordable. It makes debt more permanent. Permanent debt reshapes people. People reshape societies. And societies reshaped by debt always move toward the same destination. A future where owning something one day replaces owning something for real. The awakening. Seeing the system for what it is. Once you see the pattern, once you understand why a 50-year mortgage exists, you can never see the housing market the same way again. Because this isn't about lowering payments. It's not about expanding access. It's not about fairness or opportunity. It's about preserving a financial system that cannot risk falling home prices, even if that means sacrificing the financial future of millions. But there is one final question, the question this entire documentary has led us to. What happens when an entire nation agrees to a mortgage that lasts longer than a human life? The answer, the final, unavoidable consequence, is what we uncover next. Every era of American finance has a breaking point. a moment when the system's quiet adjustments reveal something much bigger underneath. The adjustable rate mortgage of the 1980s signaled inflation chaos. The subprime boom of the 2000s signaled a debt bubble swelling out of control. And today, the 50-year mortgage signals something far deeper. America is drifting toward a future where people no longer own their homes. They rent their lives, a lifetime of payments, a lifetime of obligation, a lifetime of financial gravity that no generation before us has ever been asked to carry. And the most striking part? This shift doesn't explode like a crisis. It spreads slowly, quietly, almost invisibly. Like a cultural drift that only becomes undeniable once you step back and look at the country from above. Tonight, we step back. The future of a 50-year nation. Let's imagine an America where the 50-year mortgage becomes the norm, not the exception. Fast forward to 2040, 2050, 2060. What does the country look like? 1. Most retirees still have mortgages. Millions enter their 60s, 70s, even 80s. With payments, they can't escape. The safety net that protected earlier generations, the paid-off home, no longer exists. Retirement becomes shorter, riskier, more expensive, more stressful. The golden years turn into working years extended. 2. Equity shrinks across generations. A 50-year loan delays equity until it becomes irrelevant. Parents can't pass down homes. Children inherit mortgages instead of assets. Wealth stops accumulating. Debt does. The middle class collapses, not through crisis, but through erosion. 3. Institutional landlords dominate the housing landscape. With individuals locked into 50-year terms, institutions buy more homes, raise rents, dictate local markets, shape entire neighborhoods. Ownership shifts upward into corporate hands. Communities no longer have roots, just leases. 4. A nation of payers, not owners. Ownership used to be a milestone, a moment of pride, stability, and arrival. A 50-year mortgage erases arrival entirely. People don't finish anything. They just maintain. They work, they pay, they repeat. A treadmill society. The final consequence, a loss of American identity. America is unique. It is the only major nation where home ownership wasn't just a financial milestone, it was a cultural promise. A promise that if you worked hard, you could one day stand on land that belonged to you. That promise built the middle class, the suburbs, the retirement system, the wealth ladder, the stability of families, the optimism of generations. If the 50-year mortgage becomes standard, that promise breaks, not loudly, not violently, but slowly, quietly, like a light dimming year after year, because a nation where people never finish paying is a nation where people never feel secure, and insecure nations do not stay stable forever. History is clear about this. Rome stretched its tax burdens so far that citizens lost autonomy. Spain stretched its silver wealth until its currency collapsed. Japan stretched its mortgages until ownership became generational debt. Britain stretched its empire until the middle class hollowed out. Different countries, different times, same pattern. When ownership dies, independence dies. When independence dies, stability dies. When stability dies, the system eventually resets. A 50-year mortgage isn't the reset, it's the warning before the reset. The entire story in one sentence. Everything in this documentary, the history, the incentives, the manipulation, the winners, the losers, the consequences, collapses into a single truth. A 50-year mortgage doesn't solve the housing crisis. It institutionalizes it. It preserves high prices. It preserves the system. It preserves the profits of those at the top. But it erases the one thing the middle class relied on for 100 years, the finish line. A future where you never arrive is not a future. It's a loop. A beautifully packaged, mathematically engineered loop of payments. The awakened viewer. If you're still here, you see the truth clearly now. This isn't innovation. This isn't affordability. This isn't opportunity. It's the evolution of a system that asks you to carry more, so it doesn't have to collapse. But the system cannot define the future alone, because the next chapter belongs to the people who recognize patterns before they tighten around them. People like you, who don't just look at the monthly payment, but at the entire timeline of a life. People who understand that ownership isn't about the house, it's about freedom. The final question, and the call to think. So here we stand. What kind of America do we want to leave for the next generation? One where families own homes, or one where families own homes? One where people finish paying before old age, or one where people work until the end? One where ownership builds the middle class, or one where permanent debt erases it? It's a choice, a crossroads, a turning point in history. And the first step is awareness. If this changed how you see the mortgage system, how you see the housing market, how you see the future being built around you, then don't stop here. Stay informed, stay vigilant, stay ahead of the system that would rather you stay asleep. Subscribe to the channel, because the truths buried for decades are finally resurfacing. And once you see them, you can never unsee them.